Hello, good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain with me, Shrishti Sharma, as well as Nehisha. And for now, it's turning out to be a freaky Friday. Very, very volatile as far as the index move is concerned. Whether it's the India VIX, which had taken a surge of around 8% on an intraday basis and now slumped to just 1% gain, or the Nifty, which is up for you on the screen with that massive 550-point rally on an intraday basis. It's been fairly volatile and a roller coaster ride that we had at our hands, almost a 600-point rally, and there wasn't a reason to begin with to see a sharp decline or a reason to come back in that big way. But there's a 1250-point rally on the Bank Nifty. The mid cap and the small cap indices are also doing quite well in the trading session. Of course, not that big an outperformance as we have been seeing earlier in the week, because these are the two indices which are in the red right now. But it's clearly the large caps that are pulling the Nifty higher today, and big outperformance coming in from the FMCG sector as well. In fact, within FMCG, ITC is higher by 2.5%. Remember, there were those reports doing around that the next GST meeting will consider 35% sin duty of sorts. That's not happening, at least at the next meeting. So there's a sigh of relief as far as ITC is concerned. So that stock is at the highest point of the trading session. HUL, UBL, Colgate Palmolive, these are some of the stocks which are reacting in the green right now. IT stocks too are at least managing to bounce back. When we started the day, Infosys, TCS, they were on the back foot. Right now, this index too is sitting at the highest point of the day. So an HCL Tech, a Coforge, a Infosys, all of these are firmly in the green. What's on the back foot then? It's clearly metals as a pack which is getting undone today. Those headlines from China regarding stimulus are not good enough. We saw that decline across the board when it comes to the European markets as well as the Asian markets. And Nifty Metal, though now having recovered quite a bit from lows of the trading session, still continues to be one of those major laggards. So an NMDC, a Tisco, a SAIL, all of these stocks are in the red. And then real estate as a pack is also under pressure. So you do have Phoenix Limited, Srishti, which is down 4%, Sobha, which is down 2.5% lower. But have to say, can't call out the market mood right now. It's been fairly volatile throughout the trading session.
Well, certainly, Anisha, we wouldn't have hoped like 300 points of cut is what we have seen on Nifty at one point in time, 800 points down. That was Bank Nifty. But look at the recovery in the benchmark indices, and it's India VIX that has also cooled off, because at one point of day it was 8% higher, and now it's just flat, and definitely giving that charge to all the bulls out there. But a lot of stock specific action as well, because in the stocks we do have stocks like Vodafone Idea, where the management commentary the management does say that they need more price hikes for a reasonable return. Jubilant Food has issued a clarification. The cement counters, because though the markets were actually turning to be quite weak, there were not much optimism, but back to back, day by day, we are seeing good brokerage notes coming in on the cement pack. They are confirming that yes, indeed, there are some price hikes, and they are building on to some expectations. And on the back of that, stocks like Ultratech Cement, Ramco Cement, they are surging away in trade today. So that's about the kind of moves that we are tracking on the stock specific movement that we are tracking right now. But with this, let's go across to our charters then and try find out that what's their strategy, how are they playing the volatility right now. And with this, let me welcome Kunal Bothra as well as Naresh Mirani on the technical side. And we also have Anshul Sehgal, who's the founder of Sehgal Capital. A very good afternoon, gentlemen, and thank you so much for your time. First up, Kunal, help us with your take on the benchmark indices, the kind of stellar run-up that we have seen or recovery. How are you playing this, and how are you looking at the index right now?
Yeah, absolutely. I think a phenomenal recovery, for the markets, and from a point where we were almost 300, 350 points down for the Nifty to close at 200 points in the green. I think it's been a phenomenal recovery of sorts for the indices. 1500 plus point recovery for the Bank Nifty from its swing lows. Now, what this tells you, one is that the market has a lot of support and a lot of buyers at every lower levels. So even though on an intraday basis there was a very sharp correction, for the index. My sense is that the major reason for the market correction was the rise in the dollar index, which has come back again to that 107 plus mark. So I think if that settles down back to that sub 107 mark, we should see one more leg of price uptick. The most important point is that after such kind of a sharp correction, there is and we've seen this historically also, that there is a change in the behavior of sectors. So, for example, in the last few days, we've seen IT index, we've seen metal stocks, we've seen the banking index being at the forefront of the market rally. Today, for example, you've seen a very good recovery into the FMCG stocks, into the infra basket. consumer durables, etc. So my sense is that going forward, we may probably see a differentiated move across sectors, and there could be a possibility that these sectors may have a fair or a higher share of positive participation with respect to the indices. And after this kind of a stellar recovery, my expectation is that we should now be looking at 25,000 being breached on the index over the next couple of days.
Sounding optimistic, Kunal. 25,000 doesn't look so far right now, is what Kunal is saying. But Nuresh, coming to you, I want to understand that while we have seen a stellar move coming in across the benchmarks, there's one space that's not participating in this rally at all today, and that's the broader markets. Now, over the last couple of weeks, we've seen whenever there's been a weakness in the markets on the benchmarks front, the broader markets have shown some kind of support coming in. Today, that's not happening. Can you tell us why this is happening, and what's the outlook when it comes to the broader markets also going into next week's trading session?
So if you look at the recovery from the lows, we ended up making a new all-time high on the small cap index. The mid cap index also recovered really well. So if you were to remove out today, we are still outperforming on the mid cap and the small cap indices. And today's move is again another one-off move. We've been seeing this happening last week also on Thursday when it was Nifty expiry. We saw a move wherein we fell 200 points, recovered all the way, saw 500, 550 pointer recovery. And the next 5 sessions, there was no follow-up price action. Today also, we went down 300 points, have recovered into plus 200 points. We are back to 24,700, 800 band. We need to see whether we get a similar follow-up move next week, or we are looking at it as just a one-day expiry move, because this is what it looks like as of now. So if we sustain and close about 24,800 next week, then we call out that it's a flag breakout and we go to 25,200.
That's the outlook on the broader markets. Anshul, hi, thanks so much for joining us on the show. Good afternoon to you. I want to talk to you about the FMCG sector because it's been the top flyer, the high flyer today rather. And, we've been reading news for the last couple of days that palm oil has now even outperformed sunflower oil and soybean oil. So commodity inflation is going to persist. You have companies that have also started announcing and undertaking price action, price hikes going ahead. So what's your outlook coming in on the entire FMCG space, given that the companies have now started undertaking price hikes? And fundamentally also, what do you think Q3 is going to shape up to look like for these companies?
Hi, good afternoon. Happy to be with you. So if you look at the last 3 to 4 years, this is a space which has consolidated. You have not seen much price action in the FMCG space. There were two reasons for that. One was that prior to COVID, this was a high-flying sector. Everybody was jumping in and buying here because it is here that you had certainty of cash flows. And so these stocks were doing very well prior to COVID. Their valuations rallied quite meaningfully. I recall that some of the leading players saw their valuations go from 40 times price to earnings to as high as 65, 70 times price to earnings. Now, after seeing such a valuation uptick, you needed to take a breather. And that's really what happened in this space. That got combined with the rural economy and consumption in the rural economy being a little tepid. As a result, we witnessed volume growth being kind of pedestrian in this space. Again, that was a reason for valuations to not see any further uptick and that consolidation to play out. Now that we've seen 4, maybe 5 years of consolidation in this space, it is likely that this space will catch the market's attention. We are also witnessing a somewhat of a turnaround in the rural economy, the tier 2, tier 3 cities. And if that plays out, this will be a sector which will be in focus. Bear in mind that while this sector has consolidated, the rest of the market has seen valuation uptick. And hence, the differential in valuations between this sector and the rest of the market, that has compressed. Hence the interest in this space. And it's quite likely that this interest will persist for some time to come.
Okay, likely to persist as far as the interest in FMCG is concerned because the sector valuations haven't moved up. Anshul, what's the take on telecom as a sector? And if you have a view on Bharti Airtel specifically, today there's a lot of news flow in the sector. Bharti Airtel is sitting with a gain of around 4.5%. There's that capex and the capex announcement which has come from Vodafone and their investor presentation talking about how price hikes are inevitable for the sector. Would you want to play this theme or just stay away?
Hi, Anisha. So this space, it's an interesting space also because there is government intent to really give tailwinds to this space. I think it was yesterday or maybe the day before that the minister indicated that they will support this sector going forward as well. There has been regulatory action in regards to the bank guarantee requirement from this space that got eased. Also, other regulatory requirements in this sector have been eased. As a result, balance sheet pressure on this space has come off. Say 2-3 years back, balance sheet pressure used to be quite intense. In addition to that, let's look at the name that you mentioned, Bharti. Let's go back 3-4 years, and the ARPUs in this space, because of competitive pressures, were somewhere in the region of 125 rupees for Bharti. And that was a significant fall from the previous 2 or 3 years where the ARPUs had reached as high as 200, from where they fell to as low as 125. Clearly, that was the bottom. The peak on competitive pressure was then. And thereafter, the ARPUs have only ticked up. So from 125, if my memory serves me right, we're at about 225 today. Now that tells you that pricing pressure is behind us, that price uptick is what this sector is seeing. And as history tells us, in sector after sector, if you see price uptick, that leads to margin uptick, and it gives ease to the balance sheet overall. ROEs go up, and that is always good for valuations. We've seen some of that play out in this sector. Probably because of the consolidation, some of it is ahead of us. So this looks like an interesting sector to remain invested in.
Okay, remain invested. That's the view coming in as far as telecom sector is concerned. But Anshul, I just wanted to quickly get a take from you regarding cement as a pack as well. Again, one sector which hasn't got enough, credit to it in terms of the valuation uptick or the stock prices uptick, because there was that lack of pricing power. Finally, that seems to be coming back. Would you agree?
Anisha, what has happened in the cement sector is quite interesting. In the last year to maybe 2 years, 2 large players have kind of instigated a consolidation in this sector. They have been buying out less efficient players and ensuring that the sector gets consolidated. The pressure also in this sector is because price uptick in this sector has not played out while costs have gone up over the last 2 years. And hence, the impact on the less efficient players has been quite intense. Their profitability has taken a huge beating. Now, this sort of shakeout in the sector is probably halfway to 3/4 way out. Like we played that out already in the past. And some of that is remaining going forward, particularly in the south. Once this shakeout is out and you have major consolidation that has played out in this sector will become a very attractive sector to look at. And it is because of this shakeout that valuations have not really gone up. As I mentioned, prices have not moved up while costs have moved up. That has impacted margins. And as a result, valuations have remained in a range. Once the shakeout is out, it looks like this is a sector which will become quite interesting going forward. And I think that we are probably 2 quarters away from that scenario playing out. But this does look like an interesting sector just now, given that it has consolidated for nearly 2 to 3 years.
All right. Thank you so much, Anshul, for sharing your take on the various sectors. But with this, we'll let you go on that. But now let's shift focus to Nikunj Dalmia's conversation with Navneen Manot as well as Shankar Sharma at IEC 2024.
And Sensex was 400, Nifty wasn't there. Sensex was 400, and we have seen the journey from 400 to 4,000, 4,000 to 40,000, and 40 to 80. And during this period, there would have been many quarters where we discuss something like this: why soaps are not selling, or why the IIP is lower, or the rates have gone up, or inflation. Many things in the world, many things in India. But in the same period, we have seen the journey of 400 to 80,000. We have SDFC FlexiCap Fund, which is celebrating 30 years of existence next month. In this 30 months, if somebody did an SIP of 10,000 rupees per month, is almost worth 20 crore rupees today. Now, I'm from mutual fund industry. As a responsible fund manager, I have to say mutual funds are subject to market risk. Please read the offer document carefully, because I'm giving you the past data and they may not guide where the future would be. But what it shows is the compounding story India has. And there are very few, and Shankar can add more because he invests globally. Other than United States, there are not many countries on the planet Earth which have done something like this, where an economy is growing consistently at a very decent pace, nominal GDP growth of 10-11% over 30 years. You have a corporate sector which can convert that growth into their revenues and profits. And you have a capital market where those profits get converted to the return to the minority shareholder. And then your mutual fund industry which delivers those returns to an investor who invests only 500 rupees per month. This hasn't happened in many places. There's no reason to believe that next 30 years won't be as exciting. There would surely be several quarters like this. It's not a linear. That's the nature of the beast, as Shankar rightly mentioned. You will have those bubble, you will have those bust, but that's the nature of the beast. But between that, the real trick is just staying invested and reaping the benefit of the growth prospects that India has.
So specifically, Navneet, about this cycle, assuming that this cycle was born in the throes of COVID, it started in 2020 or 2021. Every bull market has an age. It follows, it mounts the wall of disbelief. Then there is participation. Then there is excitement. Then there is bubble, and then there is a bust. Where are we in this bull market cycle?
No, I think we are seeing a cyclical slowdown. I don't think it is structural, maybe for a variety of reasons. I'm sure several other speakers would have talked about it. Maybe the urban consumption has moderated from the growth that it had for a variety of reasons, including maybe, I think, intended tightening of lending to households, particularly the unsecured lending, that may have some consequences. Some people are saying, I really don't know whether there's a correlation, but the money that has been lost by retail traders in the F&O market, maybe that could have got into consumption, because that got probably concentrated in few hands, and they are not spending much. Wherever they are spending, a house in South Bombay or a luxury car, I think those markets have been doing well. Because of the elections, I think the finance minister has mentioned that I think the capex got a little slowed down. I think once you see those orders and the other things fall in place, and now with maybe the inflation easing, and if we get lucky on that, and the monetary easing cycle starts, I feel very positive about the next year. I mean, there are challenges in the world. The kind of transformations, the pace of change is accelerating, whether the geopolitical, whether it's technological, what's happening in the world of AI, all of those will have massive repercussion. But I think India has always come out well, and I don't see any reason.
Shankar, you've been a big votary of market cycles. Over the years I've interacted with you. You've said that, look, the nature of equity market is that they follow a cycle. This cycle also will have a time, or this cycle will have a level. So if this bull market, which was born in the throes of pandemic, 2020, 2021, how long before this bull market reaches its climax?
That's a good question. And I've written on this theme in the last few months that typically a bull market has a life of between 4 and 6 years, if you look at long-term history. Bear markets run between a few months to maybe 2 or 3 years. COVID lasted 1 month, okay, which was, I think, my view, bigger than a nuclear war itself, because nuclear war will not flatten the whole world. This one flattened the whole world, and it lasted one month precisely. I think the complexion of bull markets and bear markets itself has changed. It no longer will be a grinding bear market that we have been used to, because of the reason, and there's a longer discussion which maybe we should have at some other point, but because we have weaponized something called interest rates. Earlier, interest rates used to be a blunt instrument as we grew up learning in economics. Now they become a scalpel, they become a razor, they become like a machete. When they take it to a problem aggressively and they hack the problem down, it's become a sharp instrument. Because of that, the bear markets are scared that if we become too bearish, we'll be caught napping, which is exactly what happened at the bottom of the COVID cycle. So with that being said, we think, I mean, at least my view is, we are in the 5th year of the bull market that started in 2020. I think we are getting the wobble precisely because of that reason. This is not a young bull market. It's somewhat of a middle-aged to a slightly late-age bull market. It's not got the legs of the 2020, 21, bull. And there is a reason why the animal in the stock market is a bull. Bull cannot run too fast for too long. Otherwise, we would have had a horse as the let's say the animal to represent a bull market or an upward market. So bull and a bear both are short-sighted. They are heavy animals. They are not very fast for long periods of time. They are ferocious, but again short-lived. So we are probably a middle-aged bull market. We might have a stumble. I think the GDP or this over enthusiasm, bubble, Josh, hosh, whatever you're saying is all symptoms of that problem. I wouldn't be surprised if we, not on an index, but maybe individual stock basis, fall 20, 30, 40%. I think it's good if such things happen. Let retail investors also learn that when you're out playing cricket, you will get hit on the body and the head. There is no escaping that. You will become a better batsman when that happens. Instead of playing on feather beds with Ranji Trophy level, go to Australia and Perth and make 100. What's wrong with that? So I would welcome that. I will get hurt too. I will also lose money. But I welcome such opportunities to sharpen my skill. So if you look at a loss as a tuition fee instead of as a loss, you go to school, do you think your loss is a tuition fee? No. You want to give tuition fee. It's the same as a tuition fee, expensive one, but pay it. So I think we are towards the later end of this bull market. We might have a breather. We might have a time-wise correction. I don't think it's a crash. I really would be very surprised because there's no condition that justifies that thesis. But we might take a breather for 6-8 months or for a year. I would not be surprised if that were to happen. Return expectations are off the charts. Navneet and I were just there, and somebody was talking to us, and he said made only 50%, and Navneet was saying only. So I think return expectations should moderate. That's the other thing.
So if you have to, let's say, and we're speaking to you after a while, so I haven't really quizzed you on this one. If you have to, let's say, advise, and again, you are a big believer of macro and then connecting with the trends, what is looking good in the short term? When I say short term, less than 1 year, medium term, which is 3 to 5 year, and what is looking good for long term, which is 5 year plus, and not asset classes, maybe themes or ideas.
For me, I mean, if you take big top down, gold appears to be a fantastic structural trade due to a variety of reasons. Too long to go here, but I think it's a secular trade. Other than that, within India itself, I am a votary, table-thumping believer in small caps.
Inventor's Knowledge Solution.
Hi there, welcome back to Closing Trades. Thanks so much for staying tuned to ET Now. Let's now welcome on board Chakri Lokpriya, the managing partner at RSV LLP, and get in his views about what he's making about the market right now. Chakri, good afternoon. Thanks so much for joining us. Wanted to get your take on the entire banking and financial space, especially after that brokerage note on from UBS that we've seen this morning. Quite the bearish note coming in, and while you have the private banks that seem to be holding up rather steady in today's trade, it's the PSU banks and the broader financials that seem to be taking it on the chin. The likes of Shriram Finance, you have IOB, Canara Bank, all of these banks are not doing pretty well right now. Give us a sense of how you would like to play this banking space, and do you believe that private banks have it in them to outperform the PSU banks going ahead?
Yeah, good afternoon. Thanks for having me. I think, the note kind of talks about everything that was already largely known in terms of, the loan growth has slowed down, provision coverage has been strong, the credit ratios have kind of held up, and, with the interest. So against this backdrop, I think what is required is, clearly an RBI needs to cut rates sooner rather than later. So now when that happens, now it's supposed to happen in Feb, but if it does happen sooner, then then becomes the cost of funding becomes lower, then all the opposites happen. Loan growth accelerates, and therefore the margins improve for the banks. So having said all that, still, all the spending is happening only with the government capex largely. And therefore, the PSU banks and PSU financiers will continue to benefit. SBI, Canara Bank, PFC, REC, these are the main beneficiaries of the government capex.
These are the main beneficiaries, but for now, the PSU banking space is clearly coming under a lot of pressure, whether it's a IOB, whether it is a UCO bank, whether there are central bank and other names from the entire banking pack. All of these are in the red right now. Kunal, if I had to ask you the strongest chart in the PSU, universe, barring SBI, which other stock would you recommend?
PSU banking name, if I exclude SBI, then Bank of Baroda is the next best bet. In this leg of recovery for the markets, we look at this not just as an intraday recovery, but we look at this from the 20th, 21st of November, is at which stocks have recovered, the finest in the PSU banking lot, and that stands to be, of course, SBI and then Bank of Baroda. You also have recovery across Canara Bank and PNB, but the only distinct part about the charts for these two names as compared to Bank of Baroda is that Bank of Baroda has a slightly higher edge. The stock had broken past above its 200-day moving average in a very short span of time, and the recovery what we've seen has been more formidable on the back of higher volumes. We also look at the correlative days. So when the Bank Nifty moves up higher, what are the odd days when the which of the PSU banking stocks have participated when the Bank Nifty moves up higher? That's what we assess in terms of correlations. Even on that front, Bank of Baroda stands to be one of the better performing stocks. So I think other than SBI, if I have to take a bet or recommend at current levels, Bank of Baroda would stand out.
Bank of Baroda standing out to Kunal on the charts at least, but let's understand the action that we have seen in the entire banking and financial space today. While private banks have recovered, remember in the first half of the day and even now, PSU banks continue to be beaten down in today's trade, along with the broader financials, the names of Chola Finance, you have Shriram Finance also that's not been doing pretty well today. Let's take it across to my colleague Gaurav, who's standing by with a brokerage note that's come out from UBS this morning, and that highlights a lot of bearish stance that the brokerage has on all of these companies. Gaurav, take it ahead.
Well, yes, amidst the volatility, UBS has come up with very interesting note. What they have highlighted is that when we talk about non-performing loans, they are saying they are seeing some kind of rise in delinquencies, specifically in the commercial vehicle and the business loan segment. Specifically, when we talk about commercial vehicles, they are seeing early delinquencies increasing almost by 150 basis points in the month of October if we compare it with March 2024. Other than that, they are also saying that these delinquencies are led by mid-sized private banks as well as NBFCs. And on the back of this, they have now cut the target price for a few NBFCs like Chola Finance, Shriram Finance and M&M Finance. And at the same time, when we come to banking sector, they have cut the target price for IndusInd Bank almost by 200 rupees. For AU Small Finance Bank, they have cut the target price by 110 rupees. And they have also cut the target price for Axis Bank marginally. What they are saying is that there is some stability which is seen in loan against properties. And at the same time, static pooled analysis of disbursement also shows some kind of deterioration in portfolio quality. And that is the reason why these concerns are rising from UBS. Lastly, amidst all these the chaos that is happening, they have also increased their credit cost estimate across the segment by 2 to 25 basis points. But even within this chaos, they have reiterated their focus on HDFC Bank, ICICI Bank and Federal Bank, saying that these banks are their top picks even in this environment. So definitely watching out on all these banks on the back of the very pessimistic note coming up from UBS.
Okay, so that's a fundamental, technical as well as a brokerage view on the entire banking pack. Thanks so much, Gaurav, for that. But in the meantime, Naresh, what's the sense on chart of Westlife development? That one is seeing quite a bit of perk up. Jubilant, of course, has been fairly volatile. And from the textile pack, it's KPR Mill and Vardhaman Textiles which are holding up. Any recommendation on the charts?
So Westlife and those names, Westlife I don't track closely, but if you look at textiles, it's a structural breakout across the board. So KPR Mills has hit a new all-time high. You have Gokaldas Exports hitting a new all-time high. You have smaller names like PDS breaking out. You have Vardhaman Textiles making a 20% move. So the structure is very clear. Nitin Spinners hit a new all-time high recently. So textiles as a sector, there are almost 20 names in different baskets, but the sector looks very promising in terms of price volume breakouts across the small to large names. So at dips, Gokaldas Exports would be good. SP Apparels is one which has yet not broken out. That looks promising for the short-term breakout.
Okay, Chakri, coming to you, I want to get your sense on the QSR space as a whole, because today Westlife seems to be outperforming its other peers in that basket. But if you take a look at this overall moves that the companies have seen, especially the earnings move, and in respect to the same store sales growth, that's not looking very optimistic. But you have some analysts who believe that there is still some danger, but things are turning to look around better for this QSR space. What's your view going ahead, and what do you believe Q3 is shaping up to look like for these companies, especially when it comes to the SSSG growth?
The QSR space has slowed down for various reasons. One is the general consumer slowdown, which has kind of impacted the same store sales growth for these companies. Now, outside of that, their products continues to be as fresh as it was. So that is not the issues, and consumer preferences have not really changed. So against this backdrop, I think it's a question of that macro recovery which is needed for consumer sentiment, corporate sentiment to pick up, for the spends to come back. Now, that is usually happens now during the festive season, and thereafter in the coming summer, which is the first quarter of next year. The calendar quarter, that is. So I think that is the time when we will see earnings recovery. The stocks have corrected quite a lot. So I think Jubilant Food, Westlife, I think begin to nibble at.
And have you started nibbling at the likes of ITC and HUL and Daburs of the world? Got quite a bit of drubbing after GCPL's Q1 update, but maybe it's unfair to paint everyone with the same brush.
That's a different cup of tea, because they are FMCG companies, and their lack of product innovation has held back the sector, and also how much more of the same toothpaste would a consumer buy. So outside of cyclical reasons of urban and local, urban and rural. So I think that as an issue is not going away for the entire sector. Whenever there is a new product introduction, you might see an uptick, but with already valuations trading that high, they're profitably run companies, but there is no catalyst for the stock prices to go up.
Okay, Chakri, hold that view, because we will be cutting into the IEC event going on right now. Suresh Kudur, the director at Academia Industry Partnership at Amrita Vishwa Vidyapeetham, is talking. Let's go across and listen in.
How we in Amrita Vishwa Vidyapeetham, a research-focused premier institution of higher learning, we are innovating and delivering the challenge. Of course, closely working with the industry. So as we deliberate on how to build a workforce for the future, let's begin by sharing a prediction that actually elegantly captures the enormity and complexity of the task. The prediction comes from a World Economic Forum study. The WEF predicts 60% of the children entering primary school today will end up working in completely new job types that don't exist today. Now, the task is cut out both for academia and the industry. The task is to prepare a workforce for tomorrow for the jobs that is not even heard of or have foreseen. And that asks for creativity, imagination, and innovation to anticipate what are going to be those future skill requirements. And accordingly, and the job contents, and then prepare a labor force with the skills and trades that will enable them to adapt quickly and successfully to any unforeseen, and then become the fuel for the growth story in the coming decades. So you cannot really predict what skills will be required in the future, but you can prepare them with those traits which will make them quickly adapt to those unforeseen. Say, to probably borrow words from Roosevelt, we cannot always build a future for the youth, we can always build our youth for the future. That is exactly the challenge, and that's exactly the action plan. So, in an era, if you look at that is marked by huge technological disruptions and the AI, generative AI, and also the intelligent robots, they're all making very big changes, drastic changes in the business process and production processes. So now, pretty much we know that everyone, the industry is changing, the businesses are changing. Actually, they are in a flux trying to respond to these changes. And this is evolving unevenly. See, when some sectors are still working with transitioning from, say, 3.0 to 4.0 or 4.0 to 5.0, industry 4.0 or 5.0, some others are already talking about industry 6.0, which will be enabled by a completely integrated intelligent systems that will fully operate completely autonomous. That would be a combination of human intelligence and artificial intelligence, human and robotic collaboration, cloud computing, the quantum computing, so on and so forth. So this requires a very multidisciplinary, multi-skilled, and at the same time, flexible, adaptive, and creative workforce. Now, we all know, the world has by now agreed that AI is going to be a game changer, and it is here to stay. Unlike its previous hype cycles, we know that there have been like a lot many hype cycles in the past of AI. It promised a lot but never delivered. This time, that's not going to be the case. AIs are being deployed not only in the industry, in many other sectors, in many other roles, be in manufacturing floor, be in the agricultural farms, be in the healthcare, emergency room, creative arts, whatnot. So all of these will ask for very different skills because your business processes are changing and the production processes are changing.
Welcome back. Well, for the markets, doing quite okay. In fact, at the highest point of the trading session, not giving up. That's the good news right now. Yes, last 10 minutes left, but more or less, we are likely to close very close to that 24,800 mark. Kunal, what does this tell you about the texture for the coming week? Because, of course, there's a big event lined up in the coming week, and that's the FOMC meeting. So the Fed decision will be out. Apart from that, of course, we're watching out for the BOE decision as well in the coming week. There is some data which is expected from India as well in terms of PPI, etc., and all of those numbers. But what do you make of the market texture if we do close above this 24,700, which was acting as a bit of a resistance all throughout this week? Are we likely to hit 25,000 in the coming week?
You know what this does, Anisha, it's a very, very valid and a very interesting question, because what this move today does is that it gives an indication that the leverage or the over leverage confidence which was there in the markets, that's now out, because today, of course, many of the trading positions would have been squared off, and now in the second half of recovery there could be more renewed confidence which could have come back into the indices. So I think everyone will be waiting for a follow through up move and then try to build on positions, which means that today's up move should have more legs going to the next week. What this also does, over the last 2 or 3 months specifically, we've seen many a times when the Nifty was down 200, 300 points, but there was hardly any point where the index showed any kind of a major recovery, and that was sustainable recovery which lasted throughout the day and the closing of the day as well as the week. Now, what this move signifies is that this recovery what we've seen is a completely distinct recovery than the last 2-3 months of the market selling, which means that the bullish texture is still intact. The base, which was at 24,000, now gets lifted to 24,200 to 50 mark, which is the intraday low for the index. And the third and the most important point, Nisha, is that the large cap stocks today have been doing pretty well. So even though the advanced sector and ratio at the last I had seen was still into the favor of declines by 1:2, the recovery on intraday basis gives indication that the recovery is more on the large cap names. And when large cap stocks they recover, it generally gives an indication that this leg of recovery is not a very feeble recovery, but it's a very strong recovery, which should have more legs going forward. So all in all, looking at all of these three factors, my belief is that 25,000 should be achieved in the next couple of trading sessions. If not, then at least over the next 1 week.
Sounding optimistic on that 25,000 mark, getting closer to us now within touching range. But Kunal, point taken that we have some up moves to this rally coming ahead. But Nuresh, I want to come to you and ask you the kind of volatility that we are seeing on an intraday basis. No matter which way we swing going ahead, and hopefully that's towards the greens only, continuing on that front. But do you believe intraday sessions going into next week could see the kind of volatility that we're seeing in the on a span of 6-7 hours that we're trading, the kind of volatility that we're seeing? Do you believe those massive jumps could also be seen intraday going into next week?
So the last 2 weeks we've seen volatility on the expiry day. So last Thursday it was Nifty. This time today it is Sensex expiry. So we'll continue to see volatile moves on the expiry day. But overall, we need to see what happens the next day. So last Thursday we saw a similar tick like today, but for the next 5 sessions there was nothing. So would look back into next week and how do we react on Monday. That is more important rather than what is happening today. So if we continue momentum and close about 24,800, we open up a move to 25,200 as well. So overall, the bias is positive after today's closing because we've seen a lot of heavyweights do well. So it's not just a few names, it's across the board on the heavyweight space.
So that's the momentum which is on the upside. But Chakri wanted a better sense on the IT pack, because in between it was all about the mid-cap IT and the niche IT companies like KPIT, LTTS, which had a bit of a tilt towards auto, which were doing well. But that now seems to be reversing and people are flocking back to the likes of Infosys and TCS. Is that the trade you would recommend as well?
IT as a sector, whether large cap or mid cap, I think is extremely well positioned from an impending US recovery that's going to come in from January onwards. Because of the new Trump administration, US tax cuts, all that will help in discretionary spending in the US, which translates into orders for the Indian IT companies. Now, whether it's the KPIT, Mindtree, Cyient, those companies will benefit from an increased, ERD spending, which kind of took a backseat in the last 1 year. And on the other hand, cloud computing, which will benefit all the frontline Infosys, TCS, HCL technology, that segment is expected to grow a solid 35-40% in the coming year. So given all this, we would buy into both the frontline as well as Infosys, TCS, HCLT, as well as Cyient, KPIT comments.
Chakri, thanks for that view coming in. So optimistic on the entire IT space across the large and the mid caps. That's the view coming in from Chakri Lokriya. Chakri, on that note, we'll let you go. Thanks so much for taking the time out and speaking to us today on ET Now. But on that note, Kunal and Nuresh, coming to you now. Kunal, you first. Tell us what are your BTST trades that you're picking up and what's looking attractive heading into next week?
So I'll go with a few large cap names. Page Industries is something which has been doing fairly well. In fact, the stock has hit a fresh, swing high, crossing the levels of 48,000. So that's something which I would suggest as a buy for a shorter term target of 50,000. Stop loss could be kept at 47,500. And of course, HDFC Bank remains to be one of the top favorites in the private sector banking names. It's very close yet again towards making a fresh lifetime high, crossing levels of 1870 plus. So my bet is on HDFC Bank over the very near term, targets of 1920 and stop loss at 1830.
Industries and HDFC Bank continues to be a Kunal Bothra favorite. We're not surprised on that front. Kunal, Nuresh, coming to you. What are your BTSC trades for next week?
So going a little more defensive, first is the Bharat Power Grid, which has been sideways and relative strength, stop loss at 330, target price of 340. Second is the Bharat Maruti, which is struggling to cross above that 11,300 mark. Today also an attempt done. Stop loss at 11,230, target price of 11,400.
Point taken. Kunal, help me with the chart check on Manappuram Finance as well as Glenmark Pharma. Quite a bit of action and volume-based action on those names.
In fact, Manappuram Finance is a very interesting case, Anisha, because I remember that there was this negative news flow for the stock and it had fallen down by, I think, 10%, 15% in just a matter of few days and dragged down to, I think, around 150, 160 levels. But, post that, there was no follow-through selling for Manappuram Finance. So earlier, I think when the stock was at 200 plus levels, I think sometime back, 6-8 months back, there was a very similar kind of a sharp selling for Manappuram Finance. And post that, the stock had fallen down significantly. So, with this lack of follow through for Manappuram Finance and the price uptick, what we are seeing is an indication that a major base or a bottom is formed for the stock. I would actually be very bullish on Manappuram Finance And my expectation that the stock could be, coming back again to that 200 mark potentially over the next 3 to 6 months at least. That's the time frame which I would, expect as minimum. On the upside, Glenmark, that's also an interesting chart. Today the volumes are exceptionally high. The stock has formed a swing low, but then recovered and come back again to close at 1500 plus level. So that's another name to look out for Glenmark. My expectation is that the stock could be giving a potential return of at least 5% swing upside over the very near term.
Kunal, Nuresh, thanks for joining us. We'll let you go on that note. Both of you, thank you so much. Let's start winding up for the day and for the week. Let's take a look at how our indices have panned out today. And if we take a look at the Nifty, it's done stellarly well for itself. 1% uptick coming in, and it's more than a 2.5% recovery coming in from the day's lowest point, a 600-point rally from the day's lowest point for the Nifty. Nifty Bank also closely following suit. Very good moves coming in, a 1300-point rally from the day's lowest point. Sensex also holding up pretty smartly, a 1% uptick coming in above that 82,150 levels for now, looking very solid on that front too. Not much to complain about. However, advanced decline ratio, despite a run up like this that we've seen today, still continues to slightly tilt towards the decline. So we'll just have to buckle up and see what Monday's trade holds for us. On that note, let's pull up the broader markets and take a look at what they have been doing, because absolutely no show of strength coming in from the broader markets today. Mid cap looking absolutely flat. Small cap still continues to underperform the entire market. 0.4% cut coming in on the Nifty small cap index as well. Sectorally then, let's take a look at what did well today and what did not. The FMCG pack was an outperformer today. Very solid moves coming in by ITC, HUL, Nestle, Dabur, Colgate, Tata Consumer, Marico. All of these stocks have done pretty well today. Followed by that, you have Nifty IT that has also done pretty well. HCL Tech, Coforge, LTI, Mindtree, Persistent. Some solid moves coming in over here. Energy, Bank, Nifty, Auto, all of these looking good. However, on the flip side, what did not do well, continue to remain under pressure over the course of the day, was Nifty Realty. You had Phoenix Mills that was down 3.8%, Sobha, Lodha, Oberoi Realty, all of these stocks have been tanking. Let's take a look at what the metal index is up to on the back of that stimulus package that we've seen. The announcement coming from China does not pan out very well for our metal space. 0.7% cut coming in on metals as well. Media, Pharma and PSU banks continue to reel under pressure today. Couple of stocks that we wish to highlight today. Zomato on the back of that tax notice of 800 crores coming in. Also on the back of the the rollout of Bistro. Let's pull up a Zomato and see what Zomato has been up to. Swiggy, very good moves coming in intraday. 6% uptick coming in. A couple of stocks like SpiceJet and Focus as well. Good moves coming over there, but that's how we're wrapping up for the trading session. All's well that ends well. Today, Friday the 13th, has turned out to be a fabulous Friday instead of a freaky Friday. Very solid moves coming in. We're wrapping up on the Nifty with very good uptick.